Hi, and welcome to this week's Symax Fintech Market Insight. As usual, we start with our disclaimer. So, trading does involve the potential risk of loss of capital and is not suitable for everyone, but hopefully it is for you. Companies offer leverage, and you should just be wary of that because you can lose substantially more than that initial investment. Everything included in here is just purely for informational purposes. It's educational. We are not trying to encourage you to trade or invest. That must be your decision. And before you make that decision, you should consider the risks involved, your financial situation, definitely your level of experience and risk appetite. And of course, only risk capital you're prepared, but more importantly, you can afford to lose. If you've got any doubts whatsoever, seek independent financial advice before you risk your capital. We're always happy to have a chat with you and tell you, the good and the bad when it comes to trading. So feel free to reach out to us. Okay, so moving on to last week. It was an interesting week. Markets, especially the stocks, got a little bit of a reality check. As I keep saying, central banks, especially the Fed, will not relax until inflation is beaten and it returns to 2%. And data came in stronger again. With CPI 6.4 year on year, the core was up 0.4 and 5.6 year on year. Retail sales up 3% month on month, which was a big surprise. But I did warn of that last week. And it was just purely because January weather was very mild in the States, so there was more people out shopping. PPI core was up 0.7% month on month, which is 5.4 year on year. I suppose the only thing you can say on the negative side is that manufacturing's lower again. It was 24.3. Fed speakers last week. There was a few of them, and they were just highlighting and warning that rate hikes just may have to go further than people in the market are expecting so far. And that pushed the Dixie back up, and the 10-year note actually went above 3.8%. Now, in the UK, inflation is still high, and again, earnings are reflecting this, up 6.7%, unemployment unchanged at 3.7%, CPI lower, but it's still double digits, 10.1%, and even when you look at the core, 5.8%. PPI came in lower at 11.1% year on year. Although it was down 0.1% month on month. And again, retail sales came in stronger. Part of this is the weather's been very generous and very mild so far in various continents. So people have been getting out. People have been managing to get to the shops easier and happier and spending. Sunak, the Prime Minister in the UK, he went to Ireland. There's rumours that they're close to a deal there, which would potentially pave the way to remove some of the friction between the UK and the EU. Talking of the EU, GDP 0.1%. So, yeah, again, just about managed to avoid first part of maybe a recession. If that can continue, again, the weather's really helped with that. And it's 1.9% year on year, preliminary that is. Industrial production, again, was lower than expected. It was down 1.1% month on month. So there's a little bit of a pattern going on there within industry at the moment. Australia, unemployment increased from 3.5 to 3.7%. And in Japan, GDP was 0.2% and 1.1% year on year, preliminaries again. And Ueda was confirmed as the new governor of the Bank of Japan. So moving on to this week, there's lots of data out, and there's more Fed speakers as well. Plus, of course, on top of that, we've got the FOMC minutes, and the Fed's preferred inflation metric of PCE, which is, in case you don't know, personal consumption expenditures. And at the moment, we're expecting that possibly to be up around 0.4%. So definitely not in the direction it needs to go to get to 2%. And as a point there, that number actually has to come down, it has to drop to 0.17% month on month constantly to get back to 2% inflation. Other data we've got out includes PMI, housing data, GDP preliminary, and also Michigan confidence. Again, all this data does help you to realise what is going on in the bigger picture. So it's important to sort of take note of that. Yeah, it provides trading opportunities, but it provides a lot more than that. Moving on to the UK. We got PMI out, and also consumer confidence. There's still odd strikes going on here and there in the UK, overpay at the moment. Again, in EU, PMI, so it's a pretty sort of general thing across the board. Also ZEW, they're both sort of sentiment indicators, and then on top of that we've got PMI as well. Germany, we've got manufacturing, CPI, IFO, which is sort of like the business take, so it's business climate, consumer confidence, and GDP. From Bank of China, we're going to get their rate decision. Very doubtful it's going to have changed at all, so it's still 3.65%. Canada, CPI, and retail sales. Again, retail sales could be that little bit higher than expected, just if their weather sort of followed what's going on in the US. So I would expect that. There's no guarantee, but I would expect that. Australia, RBA minutes are going to be released from their last meeting, plus a wage index, which you should look at because that's inflationary, and again PMI. And New Zealand have their rate decision coming out this week as well. So moving on to the macro outlook. Let's start with the market. So as I mentioned at the start of this week's insights, finally I think that the markets are realizing how serious the central banks are at beating inflation, whatever the cost. I would say especially the Fed for that. And Fed speakers during the week, they were sort of highlighting that rates may have to go even further. And then of course, as I keep sort of mentioning, they're going to stay there for longer. For me, I can see that happening for the whole of 2023. Again, just remember, this is my personal view. And then on top of that, we've had this warmer weather that's been impacting many countries with mixed outcomes. So in Europe, it's been the salvation, I would say, and it's kept them out of recession. Well, us, because I'm in the UK. So for the US, it's not been so good because that warmer January has encouraged consumers out. And again, that was reflected in that retail sales number, where it was up 3% just month on month. It just goes to show that the US economy is still strong. And I just really don't see that changing very much at the moment. Especially with the amount of stimulus that was pumped in over COVID. So inflation is sticky, and I think I've mentioned this before, but the closer it gets to that 2%, the stickier it will become, making the last bit of all to get to that 2% the toughest. But of course, that's still a dream for the central banks. They're a long way away from that. Now, here's a question for you. Do you get irritated by shrinkflation? I know I do. What that means is, you're paying the same price. Generally, you've got the same size wrapper or boxed, but when you open it, there's less contents. you know, why not be honest and make the whole thing smaller if you're going to? Chocolate lovers, and you know, I've got to include myself in that. I'm a chocoholic. You know, we've endured it for years, I would say. You know, there's chocolate bars used to be almost like a meal. Now they're just about a snack. And you see that sort of being more visible in other areas, other sectors as well, especially the food sector. Now, the stagflation, inflation without growth, is likely to hit some countries soon, I think. Are we past the recession dangers? Now, probably we're getting there, but, you know, I think a deep and prolonged one, yes, that's gone out the window now. However, you know, there's still potential for some countries to have a shallow and short one, but not sure at the moment. You know, we're going to have to see a bit more data coming through. Obviously, food and energy prices are major impactors there. So China reported that they have COVID under control. Really? You know, if they do, then they must have changed their metrics considerably, I reckon. However, again, you know, their reopening has helped. It staved off for recessions in sort of areas. And although we could possibly see inflation creep up in some sectors from their demand, so, you know, there's still that sort of good and bad elements to that. It would be interesting to know what the real numbers for COVID are in China, and how it's impacting their factories and their supplies. You know, because obviously if there's a lot of workers self-isolating, then they're going to produce less goods. Russia continues to send record numbers of missiles into Ukraine, sort of trying to soften out before the next ground offensive takes place. Now, reports suggest that they could be low on weapons, and perhaps, you know, that's similar for both sides, although obviously Ukraine is getting a lot of help from various countries. So will the next ground assault end the export agreement that is in place for agricultural products? You know, because again, that has sort of reduced the price because Russia and Ukraine are big exporters of grains especially, and also fertilizer. Russia energy. So Russia cutting production by 500,000 barrels a day from March. It really had little impact on the market. You know, it did give it a little boost the week before, got it up to $80. But then, you know, as we looked at the data this week, I don't know if you follow oil at all, but the inventory build in the US was huge, so it sent WTI prices lower. Of course, that food inflation is still too high considering costs have dropped. And you know, again, for me, that's another sort of a little bit of an irritation that I keep mentioning, because you know, there's data out that's suggesting that excuse me, food costs have dropped, and yet, you know, we are still paying high prices. For me, we're still paying the highest prices. Now, where this warmer has sort of tended to stave off recessions at the moment, especially in Europe, that is boosting inflation through January. Now, so really, based on that, keep an eye on what's happening with weather conditions in February. You know, we always consider weather to be an impactor for commodities. But, you know, January demonstrates that it can impact the financial markets too. And again, you know, how strong is your macro knowledge? We provide courses to help you to understand all of this. Workers, still a shortage at the moment, I would say. You know, again, it's this 50 plus that have retired early. They feel that they've got enough, or they just don't want to go back to office life, so they'd rather work from home. And if they can't, then they're finding alternatives. Something interesting here is sort of the big investors. By that, I'm not talking about the hedge funds, but the big investors. I was reading a bit of a report, and they're much more nimble with their investing, and they're more comfortable exiting positions in a shorter time frame than investors or definitely hedge fund managers generally accept. But of course, after all, why hold on to stocks that look as though they're going to be going down? You know, hedge yourself somehow, or if not, then get out and get back in later. You know, sort of hedge funds tend to be much more of a just hold them. Although saying that, you know, Buffett got out of his semiconductor stock, or the majority of it, very quickly. And Soros is also, you know, been much more flexible.